and welcome to Ipswich's Real Estate Podcast, a podcast where we help you navigate the often complex world of buying, selling and renting here in Ipswich and surrounding areas. I'm Steve Athanates. I'm the owner of NG Real Estate Ipswich. I'm joined today by Steve Beech from Stanford Financial on a very, very special day. Steve, you may not be aware, but you are here and it's very fitting. We're here to talk about the RBA announcement in terms of interest rates. But today is our 100th episode of Ipswich's Real Estate Podcast. Boom, there it is. So obviously tried by many, achieved by none, okay? No one has ever done 100 podcasts except Ipswich's Real Estate Podcast.
There you go.
So mate, like I said, very fitting that you're here. You've been a great friend of the podcast. And we're here, as I said, to discuss the Reserve Bank's decision on interest rates. Today is Tuesday, the 11th of August, 2026. Mate, without too much further ado, we made some predictions about what we believed would happen with interest rates for this particular announcement. We both said we believed that interest rates would be left on hold.
That's correct.
And the Reserve Bank did what?
They left it on hold. So the RBA cash rate at the moment is still sitting at 4.35%.
Yay!
So we've seen that three rate rises early on in the year. I guess this meeting was a pause. Last meeting was a pause. Again, some of the content out of today was they're still seeing what impact those sort of three rate rises previously done haven't flown all the way through, because it does take about 3 months for a rate rise to really take effect. Particularly from mortgages and even into cost of living. So, our, February sort of got into effect in probably June, and then sort of your March is just now. That rate rise that we had in May probably haven't still seen the full outcome from that yet.
Okay, perfect. Now, we did see some news prior to today's announcement in relation to inflation and the underlying inflation rate. You're probably the best person to discuss this. You actually understand it better than 99% of us, including everyone at home. So, Steve, why don't you explain what came about in terms of inflation?
There are two numbers that essentially we look at is I guess, headline inflation, which actually went from, over the last couple of months, it's gone from 4.2 to 4%, and then it even came down again to 3.8. So that's the
good.
Total cost of inflation overall. Then we look at what we call as trimmed inflation, which is when they take some of the excises out and sort of seasonal stuff, and that remained at 3.6. Now, I suppose the negative side of things about the trimmed inflation is that's actually been slowly creeping up. Went from 3.2, 3.3, 3.4, 3.6, and then stayed at 3.6. So I guess we're not, increasing anymore. So headlines coming down, trimmed is sort of plateauing. I think the economy, based on those sort of statistical data, is in a good stead.
Okay, now some of the things that this will affect people at home, and it hits everyone in the hip pocket. We've obviously seen the excises come off, fuel subsidies and things like that. So now we're back to, I guess, the real rate, and where we're getting taxed at whatever ridiculous rate we're getting taxed at on fuel. So obviously that I guess cost of living measure is now gone. We see now that there's a huge amount of people all over Australia as a result of some of the decisions that have been made that are now at risk of mortgage default. I've seen some fairly startling numbers. Do you have any feedback or any insight you can give to our viewers about what's happening with potential mortgage defaulting?
I guess Westpac has been quite topical on the news over the last couple of days. They announced their $1.8 billion profit for the quarter, so they're really doing it tough at the moment. But they actually saw a 20% downturn in applications coming through to their book. And then previously, about a week before that, NAB said that they've seen about a 15% downturn. But part of that article, which no one reads except for probably idiots like me, their default rate, or what they call as their stressed mortgage book, was sitting at 1.16% of all their home loans were in mortgage stress. That has increased to 1.19. So we haven't quite seen. But again, you got to remember that they're one of the major banks. So they're not lending to probably people who are are in a little bit more of a riskier situation. I guess when you just conform around one major bank who you need good credit and no defaults and these sort of things to get a loan with. We also not only deal with the major banks, we also specialise in what we call as non-conforming lending, which is more of that higher risk, higher rate side of stuff. I would imagine potentially some of those. So more your self-employed, low doc, self-declared loans, those type of things. They're probably the ones that are probably feeling the pinch a little bit more than probably your mum and dad standard sort of home loans.
Perfect. Good to know. Now, so for anyone who is finding it difficult and would potentially want to look at their options in terms of refinancing, because obviously in some of the private conversations we have, a lot of your business at the moment is refinance work.
That's definitely it.
So people who are looking for a better deal effectively. So if that's you, listen to what Steve's about to say in terms of some options that you might have in today's.
I guess you hit the nail on the head there. So a lot of refinancing at the moment, and it's not just so much. And a lot of people sort of focus on just their interest rate, and that's one predetermining factor. But also, I guess the overall cost of the mortgage. So there's a few different avenues that you can look at. A big thing that we do a lot of is talking about what we call as debt consolidation. So a lot of people's houses have gone up. Yes, we've seen a sort of slight bump, and we're talking probably Ipswich here or southeast Queensland. We saw a 0.7%, I guess, purchase price reduction over the last month, but we've also seen a 14.3% rise over the last 12 months. So yes, we saw a bleep, and that was probably to be expected based on 3 rate rises anyway. The perfect storm, then we had the budget come out and everyone went, oh my God, what's actually happening? This sounds crazy. There was uncertainty, those sort of things. But again, still a lot of equity being built up over the last 2 years, 3 years, even 6 months. People have still got a lot of equity. And we can consolidate your car loan, your credit card, your personal loans, and essentially get you back to one repayment. That's a surefire way to, I guess, help financial burden in the short term. Now, at the same time, it's not great to take those short-term debts back over 30 years. So you can also look at a split loan. So we can do the home loan over 30 years, and we might do that debt consolidation over 10 years. So you're at least getting a home loan interest rate, you're paying it back at a bit of a faster rate. So there's a few different options that are available with that. And in particular, bank loyalty tax. Staying with your bank for too long, they don't seem to look after you. So I'm constantly having the same conversation is a lot of times the banks will actually offer you just a low enough rate for you not to refinance across to another bank because you go, hey, it's probably going to cost me about $1,000, $1,500 to move from one bank to another, but I'm only going to save $500 a year in interest if I'm only going to save 0.1%. So we've got to make sure that it is financially viable for you as well. So what other aspects are you looking at? Not only debt consolidation, cash out for renovations, sometimes just some breathing space. A lot of people do like just to have a little bit of a buffer of savings sitting in an offset account that reduces your interest, overall interest. So you borrow the money, but you're not actually paying interest on it. Sort of thing.
Okay, perfect. So for someone out there who's sitting there thinking about what their current interest rate is on their mortgage, I don't expect you to name a particular bank or institution. What are some of the best rates that we're seeing out there that someone might consider? So if they're paying, say, something north of 7%, are there better rates out there than, say, 7%?
Oh, 100%. So I guess probably a standard interest rate at the moment is probably, if you've got that 20% equity in your property, you're probably looking at 6.2 is a pretty average rate in today's market. We're probably writing the majority of our loans at 5.99.
So 5.99. So you can get sub 6%.
Sub 6%, and that's variable rates. We have seen a lot of the banks actually reduce their fixed rates. We've even before the RBA announcement, we've actually seen a few. There was about 11 banks that dropped variable rates over the last about 3 weeks as well. Probably not on existing clientele, only on new to bank clients, and that's why it sometimes pays just to give your broker a call or your bank a call. Just say, hey, I haven't had a change in my interest rate in the last couple of months, or is it time now to have a look at refinancing and just getting that better deal?
All right, so say you're a first home buyer, you've just got into the market, you're concerned, you know that rates could rise. If you wanted to look at a fixed rate, okay, or even if you're a long established customer but you're feeling conservative and you're worried about the future, what would be some of the best rates you could get on, say, a 2 to a 3 year period?
So we're not really seeing any fixed rate sub 6% at the moment. So again, probably around that sort of 6.1, 6.2%. I guess, where it's funny, the variable rates move up and down based on, a consistency of the RBA movements. Fixed rates, on the other hand, they move up and down as well, but once you fix, you're locked in. I guess with the commentary that we're seeing at the moment, where we're probably not expecting any sort of rate movements until early next year. I think it's something like a 40% chance of a rate movement. I guess, if anything, would be up in December. But at this point in time, everyone is predicting rate cuts early next year. So,
right, so people probably best to stick with variable in the short term?
Probably we're seeing about 8% of our clients are doing variable still. Myself personally, I'm on a variable rate. I haven't really found a fixed rate that I would like to lock in at this point in time. I think there's still a little bit of uncertainty around there where rates could end up. As you mentioned before, we no longer got the fuel excise subsidy. So again, they talk about that's almost a tax in itself, or that's an inflationary pressure where people will have less money, which means there's less money conservatively going into the economy. So we're not really predicting mass inflation anymore. We're essentially seeing this sort of plateau. So I'm not really seeing rates move upward in any direction. Again, at the same time, I'm not saying that they're going to go down anytime soon. We're only August at the moment, but early next year, the RBA have forecast rate cuts in their forecasts next year. So,
all right, well, that's good to know. So if you've got a mortgage at the moment, safe bet, and we're not financial advisors, but safest bet at the moment is probably just to hang on for a little while with the variable. There are some predictions that there may be some rate cuts next year. So if you lock in, you'll lock yourself out of those rate cuts. So that's something to consider. Now, mate, obviously, as part of the announcement, obviously the Reserve Bank talks about lots of different things. There was no real standout items in this report?
No. So I guess the question time afterwards, which I'm not allowed to watch, but I listened to on the way here, it was a lot of just conjecture around, was there any talks about rate rises? There was, one or two questions raised about potential rate rises, but it was 100% unanimous, rates on hold. So there was no real any sort of banter further than that. They talked a little bit about productivity with population increasing with immigration. The only other thing that was a little bit sort of on topic but off topic was housing. So again, everybody's talking about the house prices. Again, we haven't seen as much, a bounce here in Queensland comparative to Sydney and Melbourne. But one thing that was brought up was that a determining factor for holding rates? And they said no. They haven't really looked at the housing market as a whole. We talked a little bit about the budget and some of the tax incentives or disincentives that have come out recently with the budget. Was that sort of taken into consideration? Because there was no commentary about a lot of these sort of tax and budget changes. They said no, they didn't take any of that in consideration. They get that information directly from the Treasury. So, which I think was a lot of eye-opening, okay, so the RBA haven't taken into consideration anything that the budget has actually implemented because they're just reliant on information from Jim Chalmers and the Treasury. So I don't know if that information is quite up to speed based on some of the backflipping that they've been doing.
No. Well, interesting times. So, mate, obviously it comes to that time. We need a prediction. The Reserve Bank meets again on the 29th of September.
That's correct, yep.
So that's our next meeting of the Reserve Bank. Mate, what do we think? What's going to happen? We were right again this time, but what's going to happen next on the 29th of September?
I'm still going to say that they're on hold. I hopefully the conflict in the Middle East and Iran gets sorted out sooner rather than later, because hopefully. If that, I know there was rumour mills, and there's always rumour mills on everything about ground invasion and stuff like that. If that sort of, pans out a little bit, less, aggressive than last time, definitely on hold. So that's probably my prediction at this stage.
Look, mate, I'm exactly the same. Just like you, I am on the ground. We are looking at what's happening in the housing market and the pressures that are being exerted on, the general public. I personally believe we will see interest rates left on hold again on the 29th of September. And with any luck, we won't see any further rises for the rest of the year, but time will tell. Obviously, further data will come to hand, and you'll get to hear all about that on Ipswich's Real Estate Podcast. So, for our 100th episode of Ipswich's Real Estate Podcast, we're unanimous, rates 29th of September, on hold. You heard it here first. So, I don't have anything else to really discuss. Always a pleasure to talk to you, of course, but for everyone at home, if you've got any questions, if you like the content, if you want to make any comments, you've got any questions, we'd love to hear from you. Click the link below. Your feedback's very important to us. Once again, thank you to Steve Beech, Stanford Financial. Thanks, mate, for coming in on our 100th episode. Woo-hoo. So, yes, mate, a big woohoo. I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich. I look forward to seeing you at episode 101 of Ipswich's Real Estate Podcast.